With global tensions on the rise and military spending continually hitting record highs, defense stocks are set to soar. Today, we're breaking down the top 5 potential defense stocks to buy before the next big wave of conflicts shakes the world. Before we get into those stocks, let me show you some stats on military spending worldwide and some of the potential we see in that space. This is a breakdown of worldwide spending on defense as a percentage of their own GDP and percentage of global spending. It's no surprise the US leads. 3.4% of our GDP is spent on defense, $916 billion, but we alone account for 37% of entire worldwide defense spending. This is the US military spending since 1960 in dollars. As you can see, consistently going up. But this is as a percentage of GDP. This is what actually surprised me. As a percent of GDP, declining. That's a good sign. I like seeing that. Obviously, Cold War years right here. And then as we started to get decrease in Cold War concerns, it started to decrease. So there is silver lining here. GDP is going up much faster than defense spending. And therefore, as a percentage of GDP, it is declining for the US. But look at this. We're going to surpass $1 trillion here very soon. In fact, there's a lot of estimates by 2034 that military spending in the US will be $1.1 trillion. Defense is guaranteed contracts for a lot of these companies. That's the reason a lot of people like these. As government gets bigger, we spend more and more, and these are guaranteed contracts. My guess is a lot of these companies have very little bad debts. A lot of these companies, 70-80% of their revenue comes from the US government. But now, let's get into those individual stocks. Stock number 1, Lockheed Martin. LMT. Look at this chart. Last 10 years, 242%, not including dividends. Currently pays about a 2% dividend yield. So a lot of people like these military companies, defense companies, because they pay dividends. Why? How do you really grow the business by reinvesting back in the company? That's what a lot of people are saying out there. Makes sense. I mean, at the end of the day, Lockheed Martin is a leader in this area. $144 billion market cap, $191 billion enterprise value. Free cash flow, pretty consistent. You have $6.95 billion last year, $6.45 over the last 5 years, and very much in line with net income. So this is looking pretty consistent across the board. Low 20s PE and price to free cash flow. Profit margin, 9.5%. I wonder how much of these companies, they actually just are very much structured profit numbers. I think that's probably a big part of it. But look at this. Really high returns on invested capital. So to me, the first thing that pops in my head is, boy, I really hope these guys are buying back shares when the market shifts on them. Because it seems like a very consistent business. Let's go look at their income statement to see how consistent they are. Going back 10 years, 40, 40 and a half, 47, 50, 54, 60, 65, 67, 66, 67 billion. In the last 12 months, $71 billion in spending. Not a grower, but obviously sitting here, you're looking at it going nice and consistent. Let's check out the 8 pillars here. What's the story telling us in the 8 pillars? Guys, this is almost an 8-pillar thriller. It's very close. All it needs is a somewhat small downturn extra from today, and you'll be at 8 pillars right here. Reasonable debt, buying back shares, 15%, high ROIC, revenue growth, $8 billion, net income, $287 million, cash flow. So this is what I'm surprised about. $8 billion revenue growth only led to $287 million in net income increase and only led to $62 million in free cash flow increase. Not as much as you would have thought. I would have thought a much bigger increase, especially with a gross margin here. Actually, their gross margin kind of sucks, 12% in the last 12 months. Just goes to show they bury a lot of the expenses of their company into these contracts. Now, let's see what the analyst estimates are in this business. Not a grower. $26.71 to $32 EPS over the next 3 or 4 years. Revenue growth, 71.8 to 78.6. You're not buying this. For those of you out there who love dividend stocks, this might be the play for you. Because when they're paying dividends and the stock falls in price, they might be able to take the extra cash flow, buy back shares, giving you a bigger and bigger percentage of the company. That might be a good thing for the company. Now, let's go see Stock Analyzer tool. Now, guys, remember, Stock Analyzer tool, we use this as a way of taking our estimates for the future and giving us a price today to pay for the company based on our desired return. That's all we're investing in. We're investing in a future stream of cash flow, but we don't know the future, so we have to make estimations on that. This is why we do 3 assumptions. We do 3 assumptions because we want to make sure we have a low, middle, and high assumption level. Now, for those of you out there who have our stock analyzer tool, you can pick 1, 2, or 3 assumptions. It all depends on what you're looking at. My personal belief is to use 3. Because with 3, you can do a low, middle, high, and see a range of outcomes. All right, so I did a 10-year analysis. Guys, some of the things I love here, increasing ROIC. I did 2, 4, and 6% revenue growth. Nothing to write home about. Might be low, might be high, but that's what I like about doing this wide range. Profit margin. I'm gonna go 9, 9.5, and 10. PE. Now I did 12, 14, and 16. Guys, that's too low. This is a high ROIC business, government contractor, probably gonna be around for a long time. I'd be very surprised if Lockheed Martin was gone years from now. I'm gonna do 14, 17, and 20, okay? And I'm gonna do a 9% desired return. Now, guys, this is no margin of safety, but we need margin of safety because we don't know the future and we're humans and we make mistakes. I'm putting 9, or you can put 10% in, basically the market return to get your intrinsic value for the company. But again, if you want to get intrinsic value, just buy the S&P. So I highly encourage you to put a higher number than 9% in. What return do you want to make? I hit the analyze button. The stock's currently at 605. I have a low price of 370, a high price of 680, a middle price of 500. Guys, this also includes all the dividends. So based on today's price, I'm looking at 2% to 10% return based on what my assumptions are. Stock number 2, General Dynamics. Guys, fun stat on General Dynamics. It was one of the first stocks I bought back in 1997. Let's see if I'd kept it. It was at $19 a share. It's currently at $296. That's 15x my money, plus the dividends along the way. Now, I don't know why I sold it or when I sold it, but back then I didn't have the process that I have today. But let's take a look at General Dynamics. Higher gross margin than Lockheed Martin, but a lower profit margin. So 15.5% gross margin, but about 8% profit margin. You've got a higher price of free cash flow, 25 and 23. You've got better market cap to enterprise value differential, 82 billion market cap, $114 billion enterprise value. Free cash flow. Now, the 5-year free cash flow is very consistent with the 5-year net income, like almost exact, 3.3 billion and 3.3 billion. The net income has deviated the last year versus free cash flow. Not going to worry about that. Lower return on invested capital, 7 or 8%. I'm already liking Lockheed Martin more than General Dynamics. Just on this, actually, I think Lockheed Martin looks better in every aspect. Let's go check out the 8 pillars here. Okay, 8 pillars. High PE, high price of free cash flow, low ROIC, and cash flow is down over the last 5 years versus revenue and profit being up. Haven't bought back as many shares. Okay, so immediately I'm like, if you're comparing companies, you got to sit there and say, and by the way, if you disagree with me on this, mention in the comments below why you think General Dynamics is better than Lockheed Martin. I'm only looking at the numbers here. I haven't looked at their potential contracts, anything like that. I'm only looking at the numbers. All right, let's see what analysts are saying about the growth potential for these. Okay, well, here's a differential. Looks like the growth potential and profit as a percent is much better, 15 to 21.5. And revenue growth, about the same, consistently, 50 billion to 56 billion. Low single digits, which you'd about expect here. So again, let's go look at the stock analyzer tool to determine have I ever done General Dynamics? Oh my gosh, back in 2022. And now this is going to vary greatly from what I did before. Okay, so if you remember back then, I looked at stocks a lot different. I like my process now more than back then. I was beating up the stocks immensely. I did 2, 4, and 6% revenue growth. But one thing I want to notice, guys, is ROIC is declining here. 10% down to 7%. Profit margin, 7.5, 8, 8.5, and I kept the same thing for free cash flow. I did a 15 PE across the board. Let's go back and do the 14, 17, and 20 that we did for Lockheed Martin. And then let's do the 9% desired return. Hit the analyze button. Guys, I got a low price of 167, high price of 316, middle price of 230. Those are looking like, based on today's prices, if you bought today, you have a better potential return. It was over 6% in the middle for Lockheed Martin. But that's General Dynamics for you. Stock number 3, Northrop Grumman. That's a hard one to say, but that is the correct way to say it. Let's check this company out. 10-year, 321%, not including dividend, 1.5% dividend yield. Okay, a little bit more expensive in terms of price to free cash flow at 30, it's currently 34 PE. But the 5-year PE, look at this, the 5-year net income of 3.9 billion versus 5-year free cash flow of 2.3. Okay, there's probably a reason for that, but something to keep in mind. Low return on invested capital, 8-9%. Nothing great, but it's going to be a check mark because it's still over 9%. Gross profit a little bit higher than the first two companies. 5-year profit margin, 10.5%. 10.5% 5-year profit margin. That's the highest one we've seen so far. 1.5% dividend. Okay, let's go check out the 8 pillars here. Ooh, sloppy around the board. Decrease in free cash flow. High debt level. 8.8 times its 5-year free cash flow is the debt level. Low PE, high price of free cash flow. That means lower free cash flow than earnings. Buying back about 12% of its shares. I'm not really feeling this one very much. That's my personal opinion that's the story it's telling me. Let's see what analysts are saying. Consistent growth on EPS, $25 to $35. As you can tell here from percentages, mid to high single digits, pretty solid. Revenue growth, boring, 3 to 5%, 42 billion to 50 billion. Slow and steady wins the race on these ones, I guess, guys. But remember, I think on these companies, it's about the dividend, surprisingly, and buying back cheap shares. Let's start our analysis here. I'm going to do 2, 4, and 6% revenue growth. I'm going to do profit margin of, so it's been pretty consistent at 10, 10.5%. So I'm going to do 9.5, 10.25, and 11%. But look at this free cash flow. Consistently lower, guys. 6% range. So I'm going to focus, I don't like the fact the free cash flow is so different. So if you're in our community, I really want you guys to have the conversation there about this free cash flow differential, because the other companies did not have that. So why are these guys different? This is what's so great about comparing companies within an industry. This is why you need to do that. You need to sit there and understand, wait a second, everybody else had good free cash flow relative to earnings. This one is 40% lower. Why is that? So I'm going to go 6, 6.5, and 7%. Now for PE, I'm going to do the same thing, 14, 17, and 20, and my 9% desired return. Hit the analyze button, boom. I've got a low price of 230, high price of 443, middle price of 320. I'm focusing on free cash flow here. Whenever there's such a big difference between free cash flow and earnings, I don't know the reason because I haven't researched it yet. I'm going to focus on the discounted on the cash flow here. So at 532, it's still a ways away. Now remember, guys, you might sit there and say 532, it's got to fall below 300. Yeah, that happens all the time. Don't get discouraged by that. That's what's so important about using the stock analyzer tool to the best of your ability. You have to sit there and give a wide range. This allows you to make that wide range of values. And you have to remember, the more consistent the company, the more it's been around, the narrower the ranges are going to be. The earlier the company, the younger the company, the wider the range is going to be. Don't be intimidated by that. That's what's important. Have the conversation in the community with the other members out there to sit there and determine. Though I love when I go in the community and see people taking screenshots, even on Twitter, people will share screenshots with me of their stock analyzer tool. That's the best. Now, if you're interested in getting that and you go to everythingmoney.com, you'll see that we have a limited number of daily spots for the software in the community. And the reason for that is the community, as it exists today, currently includes everything we have to offer for retirement, stock analysis, and real estate analysis. But behind the scenes, we are making changes. We're updating the software. Today, we're including everything so that you can lock in your investment in the future. But as we expand, we have to make changes. And the offers are going to be separated. These are all going to be separated into different categories. So the current offer of everything is absolutely going to go away very soon. Now, you may remember when I started this whole software and this whole site, the software was built for me. It was an Excel sheet. I would be using it on a computer. And then I get comments. How do I get your software? How do I get your Excel sheet? And my response was, guys, you can't get it. But it got us to think. So if people want this, let's give it to them. The community has grown, the software users has grown, the channel's grown. So now it's become less about me and more about how I can better serve you and give you the tools and the community members the tools who use the software to make better decisions. Now, the good news is these changes have not been made yet, but we're working on them every single day. So if you join today, you will be grandfathered in for life with all of this, all the data, all the tools. you'll get all of it and stay in your pricing tier forever. So if you're serious about making better financial decisions, probably increasing your returns, but more importantly, sleeping better at night and making less emotional decisions, click on the link in the description below. Because guys, proper investing merges emotion with numbers and software. This does both. It gives you the community to help handle your emotions, and it gives you the software to make better number decisions. Go sign up now. I'm confident it'll be the best decision you've made all year. And guys, it's $7 for 7 days. Go try it out. Stock number 4, Howmet Aerospace, $42 billion market cap. Here's what I like so far. $48 billion enterprise value. That difference right there is their debt of about $5.5 billion. Now, here's what's kind of poopy. They have for $1 billion in free cash flow versus $933 million in net income, but their 5-year average is $385 versus $533. So their 5-year free cash flow is significantly lower than their net income. But I'm glad that their free cash flow is great over the last year. Really high price of free cash flow, 43, 5-year average 110, dividend of 0.2%, high gross margin of 30%, probably because they have a lot more commercial jobs, so they're not bearing those expenses in the cost of goods sold. Profit margin, 13% last year, 9% 5-year average. Let's go check out the income statements to see what the heck is going on here. $12.5 billion, $12.5 billion, 12.4, 13, 6.8, 7.1, 5.3, 5, 5.7, 6.6. So you look at this immediately and think, oh my God, the business is declining. I think, did they sell off some divisions? So let's go find that out. We're going to go to the cash flow statement. In the cash flow statement, it'll tell us their acquisitions and dispositions. And in 2014, this is interesting. 2.4 billion. So this needs more. The only net acquisition dispositions, most recent one was 2016. They sold 2014. They bought 2.4 billion. Yet their revenue is down a lot. That absolutely needs to be figured out. Absolutely needs to be figured out. I'm jumping right to analyst estimates to see what they're thinking. Oh, wow. Over double EPS growth from 260 to 550 in the next 4 years. And revenue growth, wow, pretty solid. From 7.5 to 11.2 billion. I guess, again, it's analysts. But let's do our stock analyzer tool. Let's go see what the analysts were saying again. Pretty solid revenue growth. Okay. So I'm going to do 3, 6, and 9% revenue growth. Profit margin, look at this profit margin. 10 years is 2%, 5 years is 9%, 1 year is 13%. You're going to have a wide range here. I'm going to go 5, 10, and 15. Same with the free cash flow. PE, 14, 17, 20, 14, 17, 20, and 9% return. Guys, this is a hard one because revenue is down about 50% in the last 10 years. You've got, look at that, minus 6% a year for the last 10 years in revenue. But last 5 years have been seeing some nice growth. Yeah, it's a tough one. This is one I need a lot of margin of safety for. So the stock's at 103. My range is a low price of 13, a high price of 75, middle price of 35. Guys, this for me is the too hard pile. I wouldn't even look at this right now because I just don't know. It's just too hard for me to understand because of the wide range. Okay, you have to really do some more research to understand the qualitative aspects of this business. And again, if you're in the community and this is interesting to you, go talk about it. Stock number 5, Joby Aviation. Guys, these guys do air taxis for commercial passengers. They have a few contracts with the government, very small revenue of them, but the point is they do have contracts. Now, let's immediately go to the income statement. Annual. This is a pass for me, immediately. Revenue is crap, $1 million, and the market cap is $4 billion, $3.3 billion enterprise value, so great balance sheet. But let's go look at their shares outstanding. They're just diluting. They keep on diluting. Guys, for me, look at this. This is the analyst estimates. Loss, 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 loss. I don't see the path to profitability. You might see it, and more power to you. I can't even run a stock analyzer on this one. Now, for those of you who don't want to make individual plays on defense spending, there's an ETF. And this ETF has done pretty well compared to the S&P going back to 2005. 838% versus 583%. Now, the one thing I will say is I don't think this includes dividends, and neither does this. So this is quite the outperformance here, but as you can tell, during big dips, Look at the big drops right here, but it's starting to spread apart right here. So for those of you who say, I don't know if I can make an individual decision on individual stock, great ETF here, PPA by Invesco. It has a higher expense ratio of about 0.6%, but maybe that's worth it based on this performance. That's a decision you need to make as you sit there and decide you want to buy individual stocks. So guys, if you want to watch a video on 4 stocks we're looking at potentially buying before the end of the year, watch our next video. Thank you for your time.